I'm very excited to announce our next panel. This is quite a stacked panel we've got here. It's called What Happened on 10/10. So I'm pleased to introduce your moderator for today, Lawrence Wintermeyer. Can I get a round of applause, please, for the panel?
Welcome. I know that you've all been waiting for this particular panel today at Paris Blockchain Week. This is what happened on 10/10. And I'm delighted to have a most expert panel to help unpack what happened on 10/10, and of course Friday, October 10th, 2025. So 30 minutes before market close in the US, 19 billion in leveraged positions were wiped out or forcibly closed in crypto, surpassing the FTX collapse. The markets were correlated, actually. I think there's about 2.5 or 3% off a stock market. So everything started tanking on Friday afternoon. And generally, this was attributed to the US administration and the president's comments on Chinese imports and imposing a 100% tariff. But I think certainly in our briefing, we're all agreed that because it happened on a Friday afternoon, and even though markets were correlated, one of the disadvantages of an asset class that trades 24/7, 365 is that it was a bit more of the canary in the coal mine, or took the brunt of people looking to exit markets and looking for liquidity on the back of whatever macro rationale they had for that. So ultimately, Bitcoin fell, which we've seen. I think it started recovering and climbing up above 75. But I mean, it really had its impact, and I think over 1.5 million trading accounts were liquidated. So this is what we're going to be talking about for the next 25 minutes and try to systematically unpick what went wrong and why, what happened in different areas of the sort of value chain or different areas of the world, and then what have we learned for it, and how well are we prepared in moving into the future. So I'm going to start with you, Bradley, and give us an idea of what went wrong.
Should I introduce myself?
Yes, please.
Okay, so my name is Bradley Duke. I'm head of Europe at Bitwise. Bitwise is a digital assets only asset manager. We have about 15 billion in client assets. We have ETPs in Europe, ETFs in the US, alpha products in as well as also very large staking and on-chain business, and we recently launched a vault business as well. So, getting back to the question, Lawrence, I think you covered quite a bit of it in the introduction. There was a tweet that went out. I think it was threatening 100% tariffs on the Chinese imports into the US. Of course, this sent, caused an instant risk-off environment in global capital markets. However, most capital markets were closed, right? So it was right at the end of the US day. All the markets in Europe and Asia were shut. And so people investors were left with the choice of selling what they could rather than what they should. And this is, crypto is famously a 24/7 market. So there was the ability for people to continue to express this as people learnt about this tweet, and it continued. Obviously, when people pick up their phone and see a tweet later, an hour later, whatever, it continued this acceleration of a downward, extreme selling pressure, and people sold what they could, which was crypto. So don't forget now, we're talking 10th of October. This is really just after Bitcoin had reached an all-time high of 126,000, thereabouts. And so there was it was a time of euphoria. There was people were thinking, wow, this is going to keep going up. It's going to the moon. This is it, and a lot of retail investors were really, had got involved, and a lot of people had taken out leverage positions, and somehow, often leveraged to, let's say, not showing enough caution, very, very extremely leveraged positions. And of course, as the price started to fall, it fell from 120, or it fell to about 120 of that initial phase. It of course caused liquidations to start. So there would be margin calls. When those margin calls weren't met immediately, the liquidations were automatically run by the exchange, and within 24 hours, it was almost 20 billion in assets that had been wiped out. Liquidations that had taken place, and this was a bigger event than the sell-offs that we saw around the Terra Luna back in 2022, and so it was the largest liquidation event ever in crypto, and about people say somewhere between 1 and 1.5, or even more, a little bit more than that. Individual traders were affected, and of course, the pendulum swung from this greed to extreme fear overnight, and markets tumbled. And of course, these exchanges didn't cope well with what was happening. They sometimes, I think Binance was, people lost the ability to trade for about 30 minutes. They had the inability to trade their positions, and so it caused this kind of panic in the market, and of course a lot of people lost a lot of money and exited Bitcoin and other cryptocurrencies for good. At the time, because of the wicks that were going down, in some altcoins were going down to almost zero. I think in the case of Atom and Sui, it was touching zero. So this is extremely worrying for people and for a nascent asset class, and it was all unnecessary. But at the same time, we hope that there are some positives that as an industry we've learned from this extreme event.
So let's just get back to the key themes here. We could trade it. The market was closed, but we could trade this particular asset. Let's focus on Bitcoin. We could trade it through the weekend, and I like your description of the fear index, because when the fear index hits, people sell. I have to remind everyone, in the great financial crisis, most of the U.S. banking stocks were down to $1, which is probably, from a rational market perspective, a great indicator of the fear index. Yeah. So that kicked in, and then we had infrastructural issues with actually meeting the deluge of selling going on. That's the good way of putting it into context. Yes.
Absolutely. Yeah.
Can I open up the first question to any of the other panelists that might want to make a comment on what went wrong in addition to Brad's point? And could you introduce yourself, Tom?
Yeah, sure. It's Thomas Doyle from Xapo Bank. I run our institutional business and our global relationship management team. We have a retail platform with over clients in 100 countries. We've been going since 2013. And now a new institutional platform for about a year, 12 months. I think great summary from both Lawrence and Bradley. Look, it's a seminal moment in crypto's history. If you look back now, what you try and rationalize is, and we're Bitcoin only, so I apologize, I will always look through a Bitcoin lens. But at all-time highs, when Bitcoin's worth 2.6 trillion, I do think it's worth looking back and reminding ourselves, the wallet analysis of how many people own Bitcoin is anywhere between 100 million and 150 million people globally. And we know it's not perfect, right? By definition, you don't know where your wallet resides when you open a Bitcoin wallet. And obviously with the exchanges, you can have multiple wallets, but ballpark this consensus that's between 100 to 200 million max, right? That's still only 1.5 to 2.5% of the world's population that are actually owning Bitcoin, right? And to put that in perspective, when we have an asset that's worth 2.6 trillion, it's the 5th largest asset in the world. By definition, if people are buying that asset, they're buying it on a growth or a speculative lens, right? Because it clearly, the adoption isn't there. There's the traffic and a roadmap to get that adoption, that firms like Xapo and many others are strong believers in. So I think there's an acceptance from our side, at least. We've seen multiple cycles before. We're probably a good proxy for the OG holders, the early adopters that have done, invested in Bitcoin early and have now made an accumulative significant amount of wealth in Bitcoin, and that's why we have Bitcoin products. But I look back and go, if speculative money's come in, specifically through well-run ETFs like Bitwise and ETPs, we can't be that shocked if it goes out. And nor, it's concerning, and we'll talk about the ripple effect and the market contagion. So, i.e., the rock was thrown into the pool. What were those ripples like? And they've been very damaging to the market on a short-term basis. But if you sort of step back and look at it at a 5-year, 10-year level, the infrastructure will improve as a result of this, and we can talk through some of the principles that we're seeing this year in the convergence of crypto exchanges and digital asset trading with traditional finance trading. And I think both sides have pieces to give to that. We can touch on that later. But I think the speculative money, and it found different asset classes. There's no doubt Bitcoin, investors left crypto, invested into gold. We saw the price action in gold move through, but that money can come back. So it's on us within the digital asset framework, and what better place than Paris, that have done a phenomenal conference again, to evidence to those investors that left Bitcoin and left crypto that actually there is this long-term story. And I think if you look at the headlines we've seen this year, albeit markets volumes are down, and obviously we've seen the price action, the continuous headlines we see of Apollo buying Morpho and, MasterCard buying BVNK every week, Morgan Stanley this week, Goldman Sachs, should make us all feel happy that there is a roadmap. It may take 6 months, it may take a year, but I'm a firm believer that capital will come back into crypto, and I'm more about what can be the catalyst for that money to come back.
You raise a number of very good points there, but I think anyone that's studied markets, the history of markets and assets, would appreciate that out of early adoption, once retail investors get in, so just on your wallet numbers, and it'd be great to see the post-use case evidence of this, that quite often when there is a volatile event and we get the fear index, it's retail people that bail out, which is delivered the buy high, sell low sort of mentality. But there isn't any new news in any of those behavioral aspects of the way that this particular market behaved.
I think that's a great point, Lawrence. And actually, from a headline perspective, I care, and we care more about at Xapo, 1 billion holders of Bitcoin than Bitcoin hitting 100,000 again, right? We're in it for the long term. And so a headline of 1 billion users and 2 billion users and 3 billion users is huge. And so that's what a lot of the products we're building with partners like Bitwise and across the scheme is trying to get that broader adoption. Because until then, you're going to see speculative investment. And by the way, just to finish on that, you get a lot of negativity and connotations with speculative. I hold NVIDIA, right? Do I understand how NVIDIA is priced? Absolutely not. I've bought NVIDIA because everyone else was buying NVIDIA and it's done quite well. And a lot of people bought Bitcoin because of that, right? And so we can't blame them for not understanding Bitcoin. That's just how markets work. And so that's speculative money.
That's just how markets work is probably one of the most important
and so it's speculative capital and it can come back.
Yeah. Marshall, do you want to introduce yourself and jump in?
Check. I'll take a slightly different bent. But first of all, I'm Marshall Lipman. I'm the VP of Strategy for Hypernative. Hypernative is a real-time risk detection and prevention company. We work with 300 plus different clients to do everything from detecting hacks and exploits before they happen, and then preventing that harm from impacting our clients. We are monitoring 75 plus different blockchains in real time. We help with detecting phishing, scam, fraud in real time. We have compliance enforcement in real time as well. I think what's most relevant for this conversation is we have about 50 plus different asset managers, crypto native and institutional, that utilize us for monitoring market risks. And so one of the things that we saw on October 10th is obviously everything that we've just described happened in 20 minutes, basically. And so from a risk management perspective, if you were riding high and thought that Bitcoin was at 120 and it was going to 220 tomorrow, you're probably ignoring a lot of the risk management types of things that you need to be paying attention to. And one of the things that we saw also for some of our institutional clients is obviously they were borrowing against volatile assets, Bitcoin predominantly, and then taking stables. And the ones that were on chain were, of course, deploying those stables on chain to get yield. And they were doing this across dozens of different protocols against a handful or a dozen different chains. And that's just a lot to try to keep up with. It's a lot to try to understand systemically what's happening and how one position may be impacted by another. And so we'll talk a little bit more about this, but I think what went wrong, and just to answer the general question, is just a lack of risk management and controls in place to understand kind of if something happens, and if it happens quickly, how do I mitigate this from hurting me and my business?
Yeah, some great points. And I was going to move on to you, actually, Burak, and get your position, because you're sitting in Istanbul in Turkey, and you're in a different part of the sort of value chain than the other panelists as well. But what did you experience, and how did it look from where you were sitting?
So this is Burak Budak from Paribu. I'm a business development manager of Paribu. We are one of the largest retail crypto exchange in Turkey, but I wouldn't say luckily until that event. Regulatories, that they don't allow us to do leverage. So we were in a good position because of that, because this was like one of the largest liquidation of the leverage as well, so the derivatives as well. But as a spot exchange in Turkey, we also faced some kind of stress testing because of the liquidity. Even we are the regional player, we are a local player, we saw that our users are also following the global. And we follow the USDT for the global price, but we define the Turkish lira pairs in Turkey. And when USDT pairs downfall, our users started to do arbitrage trading, and then we saw like thousands of more trades by seconds, and it was a quite hard and big stress test for us. But I would add, for the Marshall's point, it was also lack of liquidity. So we were in a good position. We didn't face any big issue because we have integrated all of the banks in Turkey, and our users are able to put more liquidity to the platform and started to trade or buy, and it was good for them. But when you are a local, you have to connect all of the liquidity providers as well. So if we were just connected to the global liquidity provider, we would have faced bigger issues. So the founder of Aave, Stefani, I guess, he was mentioning that the biggest lack in crypto right now is a liquidity, because all of the crypto players are just trading each other, and they are using BTC versus USDT or Ethereum. So they put on-chain Bitcoin, and they get the Ethereum, and then they trade against Ethereum or something like that. So there is no outside liquidity besides the cryptos, their own liquidity. So we need to integrate more liquid assets, like more traditional assets, to the crypto to prevent these kind of events. So,
well, you raise a number of interesting points in that, because getting back to Marshall's point about the velocity, the unwinding, and again we get into leverage. Leverage is always often at the core of these very rapid, volatile downward swings. So your point's very interesting. So other than currency pairs becoming untethered, pardon the pun, and having to hedge those, because you're in the spot market, you just didn't see what many of the rest of us in highly leveraged markets saw.
Yeah, there was quite large trade, I would say, because they were just trying to follow the global markets, but they were just trying to catch the opportunity. And we were in a good position because our platform worked quite well. It was a big stress test for our technology. So we are, by the way, we use our own technology. We are not using external providers, and our custody provide. Also, the custody is our own custody solution, so we didn't face any kind of technical issue. That would be biggest problem for us in those kind of events, but I think we did good at that time.
Yeah, and I know on our call we always get back to this again in the great financial crisis. When things unwind quickly, they unwind. Money market funds were, basically trading underwater, and the whole commercial paper market got jammed up for a while. And it didn't happen in 20 minutes, but it happened pretty quickly. So. Yeah, but Marshall, can we build on the some of the things that you were speaking about, and so. One, it's kind of a compound question. When the shit hits the fan, particularly from your perspective and your institutional clients, what are the things that we do to man the pumps and, try to mitigate the risks? And then what are some of the things that we've learned out of what happened that we're now baking into our risk management thinking as we move forward?
Yeah, for sure. Well, first of all, I wish I would have bought Ford at $1 back in 2008.
You could have bought Citi or most of the banks at $1.
Yeah.
Yeah.
So next time that happens, I'm going to call you and you'll tell me what to buy.
Well, I say this because, a lot of the European institutional smart money set up financials divisions just to go in to invest in U.S. banking stocks that were all at $1.
Yeah.
That was the no-brainer play,
Next time. Hopefully there's not a next time, but if next time. So I think there's a few things to this. We've talked about a few of the items actually already, and I'll just kind of anecdotally, tell you some of the things that our institutional clients did, and hopefully that's helpful for the room. As these guys were taking out borrowed positions, they were leveraging our suite of solutions to effectively monitor a handful of different things. One of those was around liquidity pool depth. Right, so if you're taking out a position on, or you need to route a trade through, let's say, a curved stable swap pool, you want to understand continuously whether or not that trade will actually execute at the size that you're expecting, right? And you want to constantly be hitting that and just see, okay, if things, and then stress test it. Asset price deviation, as well as kind of paired asset price deviation. So, for example, if you're trading through a certain pair, not only do you need to understand kind of how the liquidity is sitting, but whether or not there's a kind of a signal that you can think about, like, okay, typically the deviation sits within this line, right? But we're constantly looking at that. And if it goes outside of that wedge, then perhaps that's a signal that something's going on. And I at least need to, in one case manually intervene, but maybe there's actually a trigger where something on chain can happen and just unwind a position or move capital around. We also saw where certain kind of more risky stable coins started to depeg a bit, and then some of these stable coins were also getting traded out of, and some of these pools for the less risky asset. Again, all of this is kind of a signal where if it starts to happen, then there's probably something going on, especially if many of these things start to happen at once. And so some of the these are 9, 10 figure. Well, before I even get into it. Also being able to monitor, I've talked a lot about on-chain, which is where we really come in. But if you have external off-chain data sources that kind of impact your ability to execute trades on-chain and you want to pull that in, you also need to be simulating those continuously. Something else that we did and our clients took advantage of. And so we had, multiple, I'll keep it relatively vague, 9 to 10 figure funds come to us after October 10th and basically say, look, Marshall and crew, the reason that we still have the lights on is because we were thoughtful going in, right? It's basically a book baked into our workflows. Every time we enter a position, this is the checklist that we run through. And then because of that, when October 10th happened, we had a plan. And some of that plan was just automatically triggered. There was some manual intervention that they felt like they needed to do, but some of these things could just automatically happen as well. So I think, to summarize, there's a level of thoughtfulness that goes into risk management ahead of time. There's the act of, well, when shit is hitting the fan, how do I actually navigate through this and can I automate some of this process? And then, the learnings would be, basically us kind of all of us educating institutions that, hey, this kind of control is possible, and you can have a risk framework for crypto native trading, whether it be on-chain or off-chain, just because it's a new asset class and there's not the traditional tools. That's not the case anymore.
That's fantastic. And just rolling through that quickly. So I've got a deviation of the liquidity pool, moving, a couple of points north.
Yeah, or it could be whatever threshold you want it to.
Yeah, you set the thresholds, but that's kind of the first, the signal, followed by stablecoin depegs.
Yeah, exactly. If you can't redeem your collateral 1-to-1, then that creates other issues for you.
Yeah, for sure. Fascinating. Well done, though. I think if you've got those size of clients, crediting you afterwards for having put in the risk framework to make sure that they made it through a crisis, that's the best accolade I think you can get. And Tommy, rolling on for that now, if we're looking at further measures we can put in, what have we learned? Further measures on risk management and making sure we've got the toolkit to deal with these sort of black swan events or whatever we're going to call them. If you could pick up some of the learnings, but I know we had a great call. It was a bit of a geek fest on our call, and we were talking about convergence because Marshall raises a really good point just on stable coins on par with the amount of high quality assets now collateralizing on-chain plays, whatever those are, even if they're back into the derivatives market, et cetera. So could you give us your thoughts on what you're seeing on that? How's it all going to be better for the next time?
Yeah, look, I definitely align with Marshall on the risk management, not just for institutions, but just on a retail level, right? I think, again, what I like to look at is, imagine you're trying to explain what happened on 10/10 to someone who's just never invested in any crypto. And I think your starting point is just the waterfall of how fragmented liquidity is. And so let's take Bitcoin again as a proxy, because we eat, sleep, and dream Bitcoin at Xapo. But basically, anywhere between 60 to 70% of Bitcoin volumes are on the perps markets. And we've seen great inroads from Bitwise and the other providers to see ETFs, and that's hugely important for everyone. But the CME futures would be the balance, right? So bulk of the activity is still going through the perps. Just some perp contracts are obviously different, but the crypto perp is obviously unique because you're a long holder, typically is your retail who looks for leverage and is paying an embedded funding cost. Some of them know that, some of them don't, right? That's just the reality of that market, to the short holder. So it's a match book on the perps that doesn't have to hedge in spot. And without getting too technical, what that means is there's already a framework for an arbitrage. So I can be short on futures on the perps and be long spot or another exchange that captures the basis. So I think from a learnings perspective, definitely this concept, we could spend half an hour on auto deleveraging, but there were some very sophisticated investors who probably didn't fully understand that their shorts could be closed off if the longs come off the book ahead of their longs. And so again, points to Marshall's business on risk management, on really understanding the fine details of the instruments that you're invested in. I think in crypto, I love crypto. I was in traditional finance for 20 years. What I also love about crypto is you'll see it this week as well. I'm sure we've all done it, and people will talk you through their products. They go, it's actually very vanilla. We loop this, we bridge that, we rope that round, we road trip it, and you're like, I've seen exotic derivatives that are more vanilla than some of the products, and that's fine. I think there's a place for them, but we have to understand the risk. And so, what's your market risk? What's your liquidity risk? What's your counterparty risk? So all sort of principles from TradFi that apply equally to crypto. The learnings, I think, are, as much as TradFi, crypto's bringing a lot to TradFi. We're seeing this move towards 24/7 trading, or at least 24/5 trading, and then ultimately 24/7. That makes sense from a commodity, at least from a commodity lens, to be able to hedge full 24/7. And then equally, vice versa. Are there instruments and infrastructure that TradFi have introduced because of the crashes, the prior crashes in 07, 08, and the flash crash, such as circuit breakers, and just some which I think regulators will start to lean on. And so there's definitely this convergence of some exchanges being everything and offering now traditional securities and vice versa. And I think that convergence is healthy, super healthy for crypto. And then I would probably say some of those implementations will make us stronger as well coming through. So a circuit breaker, you know, in that instance, when it's after hours on Friday, would certainly have helped just smooth out the volatility and the fear factor and the fear index. But the ripple is probably more interesting. And so, you know, the contagion would say from a markets perspective is literally, okay, what did the 1010 then, what was the impact on crypto markets? And it's obviously been very, very impactful, right? It's the largest liquidation ever. So a lot of speculative capital is left. It's made it incredibly difficult to run a systematic strategies. So when volumes drop and basis erodes, you know, those simple trades or simpler trades have been long spot and short perps just aren't there. And so, you know, it's an incredibly tough time for those firms, which are, you know, incredibly important for crypto because they're providing liquidity on a daily basis. But for us, you know, it's a time now to build and look back and say we have a lending fund, for instance. You know, we shock test our counterparts who we lend Bitcoin to, and so there is benefit in seeing that actual market shock, seeing that our returns hit our target returns, and saying, okay, can we actually adjust our strategy accordingly? And I'm sure that will apply to many others. And then I think that, you know, the volumes have dropped as much as 60-70% by the end of Q4. So we're seeing some sort of recovery. Just from a Xapo lens, if I bring it back personally, we're spot only as well, similar to Burak. Doesn't mean we have an issue with perps. We think perps are very healthy for adoption and it's just not our business. We're much more about long-term holders and giving them Bitcoin products. But I think I sort of look back now and go, we look at our net sales on a monthly basis just on platform, and it's a pretty good proxy for that long-term Bitcoin holder. And February was our first month in 14 months, February 26, where we saw net buys. And so despite reaching all-time highs all the way through into last summer, our holders were selling. And I think that kind of looks back to go, you know, it was very toppy, very frothy. Into frothy, I mean just very built-up demand in an asset where there's still relatively light adoption and usage, and I think that's, you know, that driver of that adoption usage will make, you know, we'll hit, very confident we'll hit that number again, but I think in tandem with more products as well. And so I think love to hear from Bradley on his side, their roadmap of not just Bitcoin but wider products, because the more products we have from, you know, providers such as Bitwise encourages that capital to come back in.
No, that's great, and I'm going to open up to the panel in a second, Bradley, and get your comments on this last point. And, you know, I said we wouldn't get into automatic deleveraging or ADL, the term, because it was Byron Gilliam that would, you know, elegantly wrote about that for me. I was at DAS the weekend after the crash and basically said, well, you know, those shorts that you were talking about got closed out because there was no more money, you know, in the contracts. There was no money in the market. The liquidity had simply disappeared. Is that a reasonable good thing for our folks here to take away about that sort of description around ADL?
I think it is. I think the more simpler point, and it kind of points to what we've all been saying, is you've really got to understand the instrument you've invested in. And so crypto is actually going to become more complex if you think of all the stable coins and, you know, as DeFi grows, and that can be a good thing. We can be equally more efficient, the way collateral is used and brought on-chain and off-chain. But I think the big takeaway is, look, you know, some regulated fund managers who have run hundreds of millions of dollars did not understand the contracts they were running. So I think that's the key. Whether it's a perp, whether it's a Xapo product, whether it's any product, you really have to understand the detail. And I think that will be on us as service providers. We've hired 10 people into our team to help educate our clients. What are you looking for from your Bitcoin? And so we can kind of address that uncertainty.
No, that's you know, that's super. We're in that position with Credit Suisse with their COCOs and their bonds anyway, which clearly a lot of investors didn't quite appreciate. So it does happen in the institutional world with, you know, straightforward products as well, doesn't it? Bradley, what are your thoughts on this and on the, you know, again, the stuff we're getting better as we move into a next crisis, which will be inevitable in, you know, some form.
It will be inevitable, and I think, you know, I should echo Tommy's points about, you know, DeFi, well, the crypto learning from TradFi. You know, I worked in TradFi for many years before, you know, switching over, and there are mechanisms in place. Of course, it doesn't completely prevent a flash crash happening. We've had similar scenarios that are played out in traditional markets. But simple things like innovation, like volatility auctions. Where you pause the market, you allow the market makers, the liquidity providers,
circuit breakers.
Circuit breaker, yeah, it's the same mechanism, but you allow them to rebalance. This brings liquidity back into the market at a time where it needs it. And I think also it's also the exchanges themselves need to invest in their own infrastructure. We have a situation where, in these stress situations, it can be 10x the normal trading volume, the normal activity, and a lot of these exchanges, and we saw with Binance, where it just shut down. It couldn't handle it. So they really do need to invest in peak trading. And especially because even though we did lose a lot of traders that day who lost money and actually exited the market, we're entering into a period. There's something we think about a lot at Bitwise. We're entering into a period of agentic trading where AI agents are going to be representing companies and individuals to handle their investment choices 24/7, and so this is going to lead to many multiples the amount of traders that there are in the market today. And they'll be much more active as well because they don't have to take a break or sleep or do anything, So this is a period. I don't think people understand how quickly this is going to happen, and we've just seen from our own personal lives how use of AI has really entered every aspect of our lives. Whether it's our business or personal decision making, and this is going to really ramp up. As this agentic trading grows.
Now, I see a man after my own heart here. You raise an excellent point because I'm not sure, even in the context of simple mathematics, how you would understand the frequency increase and then things like the latency of that until it happens really quickly, because it's theoretically one of these exponential. We've all got our own agents, whether we're hedge funds or institutions or retail investors now, doing all sorts of things for us, including, hedging, high-frequency trading, etc.
Absolutely, yeah. It's a new period that we entering into, and it's hard to know the scale of it at this stage, but it certainly is inevitable, and it's going to redefine a lot of the ways that we look at markets going forward.
I love that. Tom?
Just one point on the convergence, just practically came up in a conversation this morning. So I think convergence is great, crypto and traditional finance converging to this 24/7 model, but a great question to ask, and it comes out of 1010, is what if? And so a conversation this morning, a partner wanted us to provide leverage on a tokenized equity, which is a DAT effectively. And I'm like, okay, that's doable. We can lend against your Bitcoin, link it to the purchase on the app. It's all you could smart contract it. But who's pricing that in the weekend? Okay, it's on a DEX. Okay, but now I'm subject to some random pricing on a Saturday morning if I'm borrowing against my Bitcoin that closes out my position. So it's almost imagining, as we get a little bit more complicated, what if there's no pricing on a Saturday, or if it's down 20% even though nothing's happened? They're good questions to ask because that just makes your risk management and working with key partners like Marshall on what are my goals from this, how can I mitigate those goals. I like the on-chain, off-chain combination, but that's how we look at businesses, because you've got to risk manage that.
Well, and you raise a great point on the 24/5 versus 24/7, because I'm not sure how you hedge those exposures over the weekend.
And the press doesn't cover this. It's like, Wall Street's moving to 24/7, but it doesn't go from 24/5 to 24/7. So assets are tokenized assets and equities will be available 24/7. We've got to be really careful on that bridging risk between. That's the takeaway. Bradley mentioned, and Lawrence. The S&P was down 3%, Bitcoin was down 4%. So what? The tweet hit 30 minutes before the end of the trading day, and then Bitcoin's the proxy, and you've got to be really careful as we see more tokenized equities, and that's a good thing. But what's the volume? And that's where market makers have done an incredible job in crypto. The ones that have survived have built huge businesses, and I think they'll do very well in TradFi. And a lot of those will hopefully step in and support those tokenized positions, because that then will kind of guarantee some liquidity. But yeah, that's a risk.
Well, that's a great point. And then amongst friends who are joking around this and saying, well, what would you call Bitcoin then in this 24/7 24/7 market? Because everyone's now trying to work out what Bitcoin actually is, if it isn't a hedge to central banks or all of the different narratives it has, and it's like a super VIX actually in a way. Or,
it's exactly
it's like
a bunch
the macro.
It's a bunch of things, isn't it? It's a risk proxy at weekends. Actually, I was in Dubai. Dubai happened. The attack happened on a Saturday. Russia-Ukraine happened on a Saturday, and so unfortunately these macro events happen on the weekend, and Bitcoin typically is the most liquid hedge to trade. And so, by having other tokenized and options available 24/7, maybe we can move away from being a risk proxy to more about Bitcoin and the adoption and the usage, going back to my earlier point of how do we get to 1 billion users, how do we get to 2 billion users and holders of Bitcoin?
Well, watch this space. I'd like to thank my panelists. I think they deserve a big round of applause.
Thank you.
That was fantastic. Thank you very much, and I hope you enjoyed it. Thank you for listening.
Welcome to Signal Week.